All right. As everybody's finishes dialing in here, I will start by taking care of some of the housekeeping stuff. We are recording, so you will, for all registrations, all people who've registered for the event will get a follow-up email to let you know where it is. You can also subscribe to the Altos Research YouTube channel to make sure you get alerts when we post all our videos there. We do these big webinars every month. And every week we have a quick 5-6 minute video about what the latest data is looking at for the whole country. So if you are interested in being on top of it as soon as it comes out, follow the YouTube channel there. Um, we have in the Zoom window, there's a little chat window, and you will see that the Altos team is sharing links and other things in there. So if you want to click through to the YouTube channel or some of the other things that we referenced during the event, please use that chat window. If you have questions while we're talking, um, drop them in the Q&A window. There's a little Q&A button in Zoom. Drop them in there, and the team tries to follow up on all those questions as they come in. We can also, if they're in that Q&A window, they get saved, and we can use them for fodder for future webinars. So please feel free to use that Q&A window in the Zoom, and then look in the chat for any links as we're talking. Okay. Lots of people still dialing in, but we're going to get diving into the data in the webinar for today. Before we do the data, I want to make sure that everybody is aware that we have published an ebook at Altos, how to use market data in your real estate business. A lot of us like to look at the data. We can see the charts, but it can be confusing, and it can be this. So this book helps demystify the data. It helps teach you how to talk about the data and give some really good examples about when to use, how to use, how to use the data in each of the stages of your business. So it's not just in lead gen, but it's also in nurturing those contacts over time. It's when you sit down at the listing presentation. All of these elements are how we're using data. That's while the house is listed for sale, and how your clients really are compelled by it. So the ebook is really useful if you are a realtor, you're a professional broker in the space, and you haven't yet downloaded the Altos ebook. I highly encourage you to do so today. So a few ideas for the day. We're going to start with the big headline of the year, which is inventory. It's crazy low, record low, keeps falling. And I'm going to talk about why that is, and also what it means for our businesses this year. So for buyers and sellers, for mortgage, all of the elements of what we're doing impacted by this low inventory. And is it going to change? So we have some forecasts and some ways to look at what inventory is doing in 2021. Uh, as I go through the data, we try to make an effort to frame the data in how to talk to buyers and sellers about the market. What's happening right now? What do they need to know? What might they be worried about, or maybe have a wrong impression about? So I try to bring up that along the way. We still have about 2.5 million homeowners in the mortgage forbearance program. So what's going to happen with those is a big deal for the year. It's becoming very much more clear, but we've got some latest data on there, and so we'll take a look at that. And then we'll dive into the local data as we always do. So I've got a bunch of local reports up, the Altos reports, looking at the local data, and we can see how the trends are differing in different parts of the town. If while we're going through the local data, if we don't get to your city, one of the things that you can do is book, when you book a demo with the Altos sales team, we go through your local data. And so you can understand what you're looking at. And so take the time to reach out and connect with us so that you can get the data for your town and understand what's happening there. But I try to hit, I've got a bunch of reports open. We're going to hit a bunch of those. And then of course there are risks for the year. And we've been super boom. It's been a big year, both for transactions and for prices. It's where 2021 is starting on the same big pattern. But there are risks in front of us, so we have to keep our eye on what those risks are and then make sure that we are ready to adjust when and if the market changes. Before we dive into the data, I'm going to do a poll again this week, this month. I did this last month, and the question is, have you talked to any potential buyers and sellers who are worried about their ability to make payments due to the pandemic? We're in a world where there are people who they had their mortgage, they had 2-income family, and now they're 1-income family. They may be in the forbearance program. We know that most of the people who've been in the forbearance program have already exited, but the people who are left are the ones who are going to have more trouble making payments. So what I'm interested in knowing is that coming up anywhere in your conversation? As we look, we can see the answer is about 85% have not even had that conversation anywhere. The reason that is because the market's been super hot. And so even if I couldn't make my payment, could make my mortgage, I can sell. Or I figure out how to make my mortgage, I refinance to a new lower rate, and it becomes more affordable. So we're really 87% have not yet even had that conversation. Now, the forbearance, the current mortgage moratorium is through the end of February. It's likely that that's going to get extended again. It was December, and then it was January, and now it's February. It's likely that that's going to go. Our guess is June 30. By the time we're done, it's going to keep getting extended out. So the urgency will keep getting pushed back. But we're going to talk about how what that means for buyers and sellers in the first and second quarter, the biggest time of the year. So there may be opportunities for sellers before that transition happens. Okay. 87% have not had that conversation yet. Handful of folks have had that conversation with people who are worried about making their payments. That's very telling, and it's really still very different from what the headlines tell us. The headlines are still worried about foreclosures, people losing their homes, and it turns out that seems very, very unlikely. We'll talk more about that data as we go on. Okay, let's move into some data. So inventory. The total active inventory of homes for sale as of last week was down to 396,000 single-family homes for the whole country. It wasn't that long ago when we would start the year with 1 million homes. And you can see in this chart, there's 6 years of New Year's data that's happening, each little curve along. So the January of 2016, we had 1 million homes on. 2015 was higher. Each year, basically, we've had fewer and fewer homes for sale. The total active inventory is shrinking. You can see that in our January resets each year. So 954, 826, 775. The only year that we had more was at the end of 2018, January 2019. We had a few more homes on the market. The active market was bigger after 2018. And I'll show you why that is. But then 2020 resumed our decline. And then we had the combination of the pandemic on top of this broader transition, and adding on top of that the lowest interest rates ever. And we've made this perfect storm. So our current inventory, 396,000. If you look at each year's little trough here, each year's reset, the second week of January is that lowest, is the inflection point, and then we will move sideways for 5 or 6 weeks. We may have a couple. We'll probably have a couple of weeks that tick down, a couple of weeks that tick up. So it's probably actually we'll probably have the very lowest point is yet to come. It'll be in the 380s, and then in at the end of February is when we start having our inventory climb. So now you've got end of February, you got March traffic, you've got new listings coming on, and the country as a whole starts to get our inventory volume that comes on for the second quarter. You know, the peak of the market is going to be June 30. So all of that inventory starts to hit the market. In 2020, we had a few weeks of March before that April turn. People started buying quickly, and bam, it cratered. I fingers crossed that we have a more normal seasonal pattern in 2021, and we'll show you what that looks like. So the big question is, like, what is going on? Why is this happening? The biggest factor is interest rates. And it's not just interest rates right now. We've had a decade of ultra low interest rates. In fact, over the last 10 years, since the January, 11 years, since January 2010, the average mortgage rate for 30-year fixed has been 4%. And sometimes lower and sometimes higher than that. That remember when I mentioned that the one time inventory started climbing was end of 2018 for January 2019. And if you see what happened at that time, in 2018, mortgage rates spiked. They spiked only to 4.8%, but they spiked. They spiked from the threes, and it put a significant damper on demand. And so because demand slowed off, inventory built up in the second half of 2018. And we started 2019 with a few more homes. The reason that the inventory is built, so demand falls off, but the other thing that's happening here is in this span of the last 10 years, we've had a major transition to taking homes that were for sale, turning them into rental properties. In 2010, there were about 10 million single family homes that were rental properties. By 2020, that was almost 18 million. So what's happened is that it's been a really good deal to, when you buy your next house, whether you're moving up or moving down, to keep your first house, because your mortgage is so cheap, your second mortgage is so cheap, the two payments are reasonably inexpensive, and the income, the rental income from the first property, now more than pays for your mortgage. So it's been a really good deal for individuals to keep their home and turn it into a rental property. It's also, of course, been a really good time for the institutional buyers to buy single family homes and create them as rental properties. And so then in 2020, now rates are in the twos. And so if you are in a mode where you're thinking about buying another house, you're thinking about buying a house in one of the Zoom towns for remote work, it's really a good opportunity to keep your first house and just buy the second one. And so that, as rates have fallen into the twos, that's accelerated both the demand, and it's a function of keeping the supply low. So the thing we have to keep our eye on is when rates start climbing, they will, um, and they will in response to an accelerating economy. So how quickly do they climb, and how far do they climb? So my expectation is that if rates climb to above 4.5%, that's when we will notice a significant slowdown in demand, and we will see it in the supply start to climb. Meaning now all of a sudden it's not as super affordable to buy the second house. I should probably sell the first house to finance it. So that's the big window, and it's a 10-year cycle that we've been in. Because rates have been so low, we've built this stock of rental homes, and we've been under building new construction in that time. So we actually have constricted our supply of available homes. So there's 7 million more homes that are now rental properties that don't come to the for sale market each month. This is what it looks like when we look at the listing volume each week every year. There's a normal pattern, and as I mentioned, we have this, where the thick line is the year January reset, the lowest point of the year, which we just passed. We've got 1 week now past January, the first week of January, and we'll start ticking up. We'll have a good climb of new listings in the next several months, but the transaction volume is high. And so it'll be slow to build, but we're going to build our total inventory, especially starting mid-February. You start to have February and March listing volumes. What happened in 2020, of course, is we had our normal January, March. We had a lockdown period. Very few things happened, and then starting in April, the demand started, but we never hit our peak of listings. So we had normally we might have 100,000 new properties listed in a given week. There's a little peak each year. We never had it. So we took out all this volume. So I do expect that 2021 is going to have a more normal shape to it. I don't expect that we're actually going to hit our 100,000 peak week at any given time. I think it's going to be a slightly muted, maybe in the 90,000s, but give us to a more normal shape so that we get some listings, we get some volume, we get some transaction volumes to be able to have this year. And so here's what it looks like when you say, what's going to happen to inventory in 2021? These are each line here is a year. So you can see the start. So we have a few months of low, and then it picks up through the second quarter. Our total inventory peaks in August, and then starts to, as new volume kicks off, falls off in the third quarter and the fourth quarter, and then it curves back down to reset the year. So we want to see that normal expected pattern. Each year is a year. You can see that this dark green year of 2020, where we never had our summer. The dotted line is what we're projecting for 2021. We can see that somewhere about September we'll cross over. We'll have more listings, we'll have crossover, and end the year slightly higher than we started. So it's fingers crossed that we don't, like, if rates dive from here, you can expect that we never get that inventory. But my guess is that as the 10-year bond rate is increasing, as the economy starts improving and we get past the pandemic crisis, that mortgage rates will rebound a little bit. And so that we were likely to see this pattern in inventory for the year. It's still restricted, and it will take several years, 3 to 5 years of rising rates before we see anything like we've ever seen, right, we ever used to see. We're a long way off from a normal inventory market. Okay, let's talk pricing. So we ended the year, or started 2021, median home price in the US is 336,900. It's the active homes. This is every home in the country. We're up 10% year over year. And obviously a massive price gain. This is prices. This also has implications for equity. It is pretty much across the country. There are a few local markets where you have, local peculiar conditions that go into place, but in general, this is a across the board view, and so 10%. The second week of January is always my favorite week to look at the pricing numbers. The blue line here is the median price of the newly listed cohort. So these are the properties that come to market in a given week, and that cohort is obviously the smallest at the first, last December, 1st of January, and they spike now as the new stuff gets listed for January. So the earliest good inventory starts coming on right now. And so every year we can see this second week of spike. So this, the blue line, the far right here, is this little spike for the beginning of the year, where 299 is the median price of those new listings, and that's going to climb very quickly. This is a leading indicator for where home prices are going to be in the next several months. The economics term is the wisdom of the crowds. What happens is, when we go to list properties, the sellers and the listing agents have all the information about, well, I know exactly how many buyers I have. I know how many offers the house down the street got. We're going to price this one a little more aggressively. We're going to price it a little higher, and we're going to see if we can get the offers. And so that information gets baked first into the new listings. So there's a handful of new listings this week. The prices are jumping. Next week, they're going to jump some more. And after about a month or so, you'll see that the dark red line will start to climb for the year. So what we like to see here, we can see that the low point of the new listings each year climbs, but this year it has a big spike. So, and that is already on a steep incline for the first quarter. What this tells us is, we all, as a lot of us know, but it tells us in the data that the demand is there. There is a floor on pricing. We're already positioned for a very strong price appreciation year for 2021. Now, we may have, for example, if rates spike significantly, you might see a damper on that at the end of the year. If rates stay in their normal pattern, then we're likely to see another 8-10% appreciation year, based on what the early leading indicators are saying right now. Fasten your seatbelts for another big year. Here's another leading indicator. If you paid attention to the Altos data, we use as a leading indicator, as a proxy for demand and as a leading indicator for pricing, the percentage of homes on the market that have taken a price reduction. So in general, there's a band that homes trade in. If you want to think about how this number works, about a third of homes, as a rule of thumb nationally, about a third, take a price, are priced, they're overpriced, and they take a price cut before they sell. And so sometimes that overpricing is strategic. Sometimes it's accidental. Sometimes it's a demanding seller. Whatever the reasons are, about a third of them take that cut before they sell. And there's a normal seasonal pattern. So that the price cuts are lowest in the early spring. New inventory is coming on. We're pricing aggressively. We've got demand. Now the houses that have stuck around, all of a sudden it's June, and I'm like, wow, we've been on the market for 90 days. Maybe we overpriced it. Now those prices will start kicking in. So that's price reductions start ticking up in March. They tick up all the way through the second quarter and through the third quarter. And so then in the fall, now you get August and you get houses that didn't sell in the summer. Now you say, oops, we got to do our price reductions to move them before too late. And you'll see price reductions peak in November, and then boom, they reset for January. Okay. What this tells us is when you're expecting a third of the homes in their price reduction, a third of the homes to reduce prices, but only say 25% need to, that's because demand is higher and we're not taking price reductions on the active listings now. That means the transaction prices that happen in February, March, April are going to be higher. So this is why price reductions are a leading indicator of where the transaction prices, the sales prices, are going to be in several months. If you look at data like the Case-Shiller Index or some of the NAR reported data that report on sales transaction prices, those are always backward looking. So you might see like NAR at the end of the month will report December data. You'll have the Case-Shiller Index at the end of January actually reports data, the December number, which takes in October, November, and December transactions. Like it's really lagging. And what the leading indicators tell you here is that those headlines are going to be super bullish for the next 4 months at least. And of course, longer than that, but the data right here shows us the next four months. So I think the last Case-Shiller Index number said prices had appreciated by 8.9%, but they are several months old. So they're going to get 10%. They'll show their 10% number that we can already see in the Altos data, and they'll start getting there in the next several months as the lagging sales data catches up. And really, this is why why in Altos we focus on the active market. Like the active market is what you're going to see when your client walks into the market today. It has all the signal about the current levels of demand. It's not this like houses that sold last month or 2 months ago. This is the real powerful signal for your clients and how you can reach them so they know what to transact. So we're at 22.3% right now, where you might have, we started the year last year at 25%. You can see actually in this chart, the peak price reductions was at the end of 2018, which, as I mentioned, was when the rates were spiking. So you could see how demand went from start of 2018 very strong, had reductions as demand fell off, and so you could see that 2019 started with a higher level of price reduction. So you could see how that was baked in. Rates fell all the way through 2019 through 2020, and so price reduction way down. Demand is up, prices are up. Like that's the leading indicator that we see already. So in a few months, hopefully we're going to start a normal seasonal pattern here too. It's going to be lower than normal because demand is high, but we'll start to resume our normal seasonal pattern. You can look at this data in all of your local Altos reports too. So all of these things you can dive into your local Altos reports when you're talking about your local market. Price reductions is very local, regional. For example, Arizona tends to have a higher band than California. and we can show you. I'll show you some of those examples as we dive in. Continuing on the demand metrics, days on market. Here's 4 years of a days on market. It has a normal curve as well. The peak of the demand is normally June 30, July. That's when things are moving fastest. They've been on the market shortest, and then in the fall things sit around longer, and so days on market climbs. 2020 was nuts and out of sync with everything, but encouragingly, the fall, since October, we're in a much more normal seasonal pattern. Demand is higher and supply is lower than normal, but at least we're in a normal pattern. And that's encouraging to me because that implies we're going to get some more listings, we're going to have our transaction volume, and we're emerging from the crisis into a merely crazy hot market. At Altos, we have a proprietary metric we call the Market Action Index. This takes both the demand and the supply, and it turns it into one number. It turns it into this speedometer, and when that number goes higher, that's because inventory is tighter, demand is stronger, and we can see, for example, that as that increases, we've moved stronger into a seller's market. That implies higher prices in the future. That implies more seller power. As it falls, that's because inventory is building and demand may be weakening. And so below 30 on this scale means buyer's market, and much below 30 implies that prices will probably be falling in the future. Couple of things when we look at the top chart here. So the 30 is the seller's market. We've been in seller's market for several years nationally. Inventory, as I pointed out, has been falling. So demand stays the same and the inventory falls. That's seller's conditions. And then, of course, in 2020, this red line, the dark red line here, spiked. Crazy hot market. We've been in hot market. The dotted line is a weekly the weekly readings, and then the dark red line is how it's smoothed out over time. So we're elevated, we're moving into a cyclical, normal seasonal pattern, but way seller's condition. And so like it is another of the leading indicators that tells you you're going to have bullish headlines from the traditional media sources for many months. In your local reports, keep an eye on the little speedometer. It's super handy. It's the at-a-glance answer to how's the market. So somebody goes, hey, I'm thinking about buying in Sacramento. What do I need to know? We can hand them a report and we say, keep your eye on the Market Action Index. It's super strong seller's market right now. So if you want to buy, we have to be smart. We got to make offers. We have to make them quickly. It's an excellent way to help frame the expectations of your sellers and your buyers with an at a glance. So a lot of people are confused by the data. They're like, oh, the numbers are bouncing all. What do I need to know? I want you to look at one number. So we'll look at some of the Market Action Index when we dive into the reports here in a minute. Before we shift into the local data, there is an important message that I think is not yet through to the industry. And that is one of the things that's happened this year, we've had demand, and it's not just pandemic demand, it's demographic demand. We are entering what could be possibly the best decade, the strongest decade for housing demand that we've had in many decades. What's happening is the millennial generation is the biggest group of people in one cohort, bigger than the boomers, and they are now in their 30s. And as they go from their 30s to their 40s, they are in home buying, family building mode. Demand for real estate by the millennials is going to be high for the decade. Now, that is, irrespective of interest rates. It's going to be high for a decade. What's interesting is that the boomers are now hitting their 70s. So boomers have held onto their properties way longer. And part of that is because their mortgages are really cheap. So it's really inexpensive to hold on to their properties. But it could be that we get into this mode where boomers are now moved from 70 to 80, and finally we get some of that inventory loosening up that millennials can buy. Um, my Gen X generation got squeezed in the middle by both of them, and so it was a hard decade. But what's interesting is you think about the mortgage crisis. The mortgage crisis hit when Gen X, the smallest demand section, was rolling into their peak demand areas. So all of a sudden, we coupled the crazy mortgages and the building in the first part of the 20th century, and then all of a sudden you hit that with a small demographic, and it compounds the challenge. So we're into these are tailwinds. These are big generational tailwinds. And so when you look at, you hear headlines about bubbles bursting and, real estate market can't be sustained. One of the things to keep in mind is that we have this massive group of millennials that are moving into their buying mode. Okay, as we look at the local data, there are some communication things that I'd like you to keep in mind. One of the things is, we're talking about real estate market data. We put in reports. We put those reports in the hands of your clients, your buyers, your sellers, your prospects. And very often, one of the great lead nurture tools has been, in the last, say, 15 years, the listing alert emails. So, hey, here's a new listing in your price range in your market. That's a great way to nurture your leads. Unfortunately, when there are no new listings and prices are skyrocketing, there's no listing alerts. When there's no listings, there's no listing alerts. So what do? One of the things that you do is you follow up with the market data, because the market data is always fresh, it's always applicable, and it's for buyers and sellers to be able to stay engaged with you, their realtor, over time. I bought a ski cabin in the mountains 5 years ago, and I would get my listing alerts from my agent. They would come every week, and here's new listings, and it's great. Um, I haven't gotten a listing alert in a year. There's nothing listed in my price range. There's no inventory. So now all of a sudden, I haven't heard from my agent in a year. But the market data is fresh every week. So keep that in mind as we're looking at these reports, and think about how you might be communicating with your buyers and sellers. The other thing that, because we're in this tight inventory market, what are we going to do? For sellers, the opportunity is that everybody has tons of equity. We're getting fast offers. It's a really great time to sell. So that communication is a powerful element. And I believe that we will see this super hot market actually pull inventory, demand creating its supply during the year. And so being on top of that message is an excellent way to generate the listings. And, there may be people, many of your contacts, they may not be paying this close attention. They may still be afraid or worried that there are no buyers out there. They may be afraid of the pandemic. So making sure they see how hot the market is, how tight inventory is a powerful communication tool to making that happen. And again, remember, we're talking about the millennials and the boomer targets in a buying and selling opportunity. Okay, I'm going to switch my screen right here to the web. Okay. Um, This is actually the back end of the Altos system. If you haven't seen it, one of the great things is where I have all my reports and I can see all the people who've been reading my reports, and I can click in and see their names and emails, and I can see where they're coming from to look at the data. Um, and if you are not familiar with the back end of the Altos system and you've only seen the data, I encourage you to come over to altosresearch.com, book a demo, and see how you can take the data just from being data and turn it into the communication, the client service mechanism, the multiple times that you get to touch and engage with your clients every week, month, year. I encourage you to book a demo and do that. That's just a quick plug, real quick. So on my local data, the first one I want to start with this week is San Francisco. You might remember that as we went into the pandemic and the lockdown, there was a big exodus from San Francisco, from New York, and the cities where we had remote work was really easy. And the Zoom towns, whether it's Tahoe, Truckee, it's Bend, Oregon, or it's Palm Springs, or it's Cape Cod, the um, the the towns where, or even Boulder, Denver, where people can move and they say, hey, I can have a great quality of life if I'm not working in the office. So what's fascinating is this is looking at condo data in San Francisco. And there's always been a lot of cash on the sidelines in the last few years, waiting for a bubble to burst so that they could swoop in and buy. And that's true, I think, for the whole country, not just San Francisco. It's been especially true in San Francisco. And it sure looks like the buying opportunity in San Francisco, like if you blinked, you missed it. The Even condos in San Francisco, prices have stabilized. They came down significantly last year, especially in the middle of the year. Prices have stabilized, but active inventory is way down. Uh, because it's so inexpensive, demand is up. So you can see our market action index is actually climbing into sellers condition. Now it's still slight sellers market. It's not a strong sellers market like so much of the country, but if you blinked, you missed your buying opportunity. Like it's already there. It's actually still kind of a reasonably good buying opportunity because prices are lower than they were a year ago at this time. But really fascinating. Demand is so high across the world, and you can see condo prices in San Francisco. You can see exactly where the demand is. The demand slows down at the multi-million-dollar range. It's higher, but demand is very quickly about $1 million. It's things are moving very quickly. I thought that was really fascinating to see. Like, that narrative is over. This is Denver. Denver's been one of the hottest markets. This is all Denver metro. Strong sellers market in Denver. Big price appreciation for the year. I like to look. We looked at percentage of properties with price decreases. We looked in the data here, and so you can see a normal 30% range, and then all of a sudden we're down to 20%. So that bodes very strong for Denver, the Denver metro area for 2021. This price increased measure is really fascinating. So these are homes that were on the market. They got bought, or sometimes they just got delisted and then they brought back at a higher price. This represents flips. This is also the iBuyers, the folks like Zillow and Open Door. So they're listing property, they're buying a property, and then they're holding it, and then they're listing it, and they're bringing it back on the market. If they can bring it back on the market at a higher price, that's showing up here. 13% is a remarkably high number. It shows high investor activity, but it's also because prices are rising so quickly. So you'll see nationally that number is more like 5%, and it's high. That's high for the country. So 3% might be normal nationally. We're at 5% nationally. And so I've got some of the markets where where price increases is actually higher here. Here's an inventory, the multi-year inventory chart for Denver Metro. You can see how, 5,000 homes normally, and we're more like 2,100 right now. It's 60% lower than normal. You can see when we look at the price range segments, in the Altos data, we always look at all the data in price range segments. The high end of the market may be behaving very differently from the low end. And so in the Denver metro area, high end is 1.7 million, low end is 360. And you can see exactly, especially look at the DOM number here, you can see 59 days versus 173. So, the bigger stuff, bigger homes on bigger land is still going to take a little bit longer to sell, even though that's very quick. You can also see that those are new construction versus, 73-year-old properties that are, at the lower end of the Denver metro market. So Denver is one of the hottest places in the country right now. Here's Sacramento. We were talking with some clients in Sacramento recently, and Sacramento, in this strong sellers market, Sacramento benefits from strong inbound immigration. It gets Bay Area buyers who are going for better pricing. So it has this higher level demand. It has a younger demographic. So you can see this super strong sellers market settled in there. Here's the inventory chart for Sacramento. And, we've been, and Sacramento's I think it's 800,000 people or 700,000 people live in Sacramento. There's only 500 homes for sale. And now it's only 315. So you can see down from 1,000 just a couple of years ago. So 70% fewer homes on the market right now. And Sacramento's a great rental market. So it's a great market to keep your first home and turn it into a rental. So that's, as I mentioned, that's been happening more and more over the last few years. And so Sacramento and the Central Valley in California is a big opportunity for that. So significantly fewer homes for sale every year. Price decreases in Sacramento at only 20%. Here's our increases. So this is up from 5, 6, 7% last year, up to 9% now. So lots of flips starting to happen there. Only 6% relisted. And this always takes a little bit of a spike at the beginning of the year. So properties get taken off over Christmas and then in the holidays, and then they get relisted in January. So that'll climb a little bit for the year. If that grows too high, if relist grows too high, 15, 20%, that kind of thing that's a negative signal on demand. That means, deals are falling through. That's our leading indicator for where prices are going to pull back in the future. So keep your eye on relisted if you're worried about your local market and what might happen in changing conditions throughout the year. Here's Texas. This is just state of Texas. State of Texas has a huge year, a big 10% year for the state overall. We can see the strong price appreciation. Texas has a big whole state of Texas is 10% price increase. So 10% of the properties taken a price increase recently. Lots of iBuyer activity, lots of rental activity, lots of flips. So it's a big, obviously, investor friendly market for the whole state. Only 1% of the homes on the market in Texas being relisted. That's a strong indication of demand. And that's Texas state as a whole. If we look at, for example, Austin is an even hotter market. It benefits both from broad immigration, also Zoomtown benefit, where California workers, New York workers get to go and work remotely from a nicer, bigger home in a friendly area. So strong sellers market in Austin. And you can see our inventory year, 438 single family homes down from 1,200. Like, how nuts is that? So you can see this pattern over and over again in the areas where we have this combination of nice, strong local economy plus Zoomtown benefit. Um, and you can also see when we look at the price ranges in Austin, the high end of Austin, 3 million, is significantly slower than the $500,000 price range. We were talking with some. Let's switch. I'm going to go a little more quickly. We're talking with some clients in Sun City, Arizona. So now you've got really interesting, a very homogeneous population of property, like very similar, and a lot of foreign buyers, a lot of people coming in. So now you've got people moving into town. Or thinking about moving into town, how do you keep connected with them when you don't have listing alerts? You keep connected with them with the market data so that they know what they're going to see when they walk into that market right now. In Sun City, it's really interesting. Very tight price range. So 237 versus 370. They're all about the same size. They're all 3-bedroom, 2-bath. They're all about the same age. And you can see that exactly where the demand is. But there's significantly fewer of them on the market right now. So if you are a buyer, we have opportunity, we have some inventory, but we need to take action quickly. A couple more real quick. This is Dennis, Massachusetts, Cape Cod, Massachusetts. I was talking with a colleague yesterday, and we looked up where he is, because he was in Boston and he moved to his house in Dennis and hunkered down for the year. And all of a sudden he hasn't left. So we were looking at inventory in Cape Cod, down. It's a smaller town, but down from 28 down to 10 in the last couple of years. And so you can see the same pattern all the way through here. Dennis is a strong seller's market. Here's something interesting in Dennis. Let's look at our price ranges. A lot of the properties, 134-year-old, probably, like, that's an old part of the country. But look at the days on market is actually stronger in the high end of the market than it is at the low end. And if I look at the days on market by the price range segments, you can see most times, these are a couple of years ago, the expensive stuff, the blue line, takes longer to sell, right? Makes sense. The green line is the next takes longer to sell. Then all of a sudden this year, everything is moving quickly. And if we zoom in right now, in the last handful of months, the high end of the market is moving more quickly even than the low end of the market. That's an important signal to point out to your buyers and sellers. They may not get it. If you've got a $3 million property in Dennis and Cape Cod that you can sell, and your seller is afraid because they may be they're afraid of how long it's going to take, they may not recognize the opportunity here. So it's actually inverse from normal. That's a really neat a bit of data. So we've got let's see, one more. Let's look at Seattle real quick. Seattle's an interesting one. Seattle has had like, say, San Francisco, less so, or New York, had the opportunity to move out of city proper into more remote or more Zoomtown areas. So inventory in Seattle is actually about where it's been the last few years. It's still a super tight market and still in a strong seller's market, but not a crater. Not inventory is not 80% lower than, or 60% lower than where it has been. We can see exactly where the demand is in Seattle, and so the high end of Seattle is only a little bit slower, but $2 million properties as opposed to the $500,000, $600,000, $700,000 range. Okay, we're getting close to the top of the hour. I am going to stop the share there. Actually, let me share my screen again there. And zip down to my last slide. And then we'll wrap it up. And hopefully see you. So when we talk about the risks of the year, we haven't, if you haven't been listening to this message lately, the important thing to remember is that the headlines are still very afraid of a giant wave of foreclosures or distressed sales that are going to happen this year. The fact is, they're not going to happen. I feel very confident in saying that we're not going to have a big wave of foreclosures. Because we've had such strong price appreciation and continue to, we have record levels of home equity. So even if you are, for example, a couple who's gone from a 2-income household to a 1-income household, and you're not going to be able to afford your mortgage, the worst case is you sell your house, you downsize, and you take your cash. So we know that that's, and it's, as I mentioned, we did the poll at the beginning, and 87% of you have not even had that conversation come up, a distress sale, because nobody's distressed. Even if you're not paying your mortgage, very few people are in a place where they're going to have to do a distress sale. A short sales basically don't exist. And then if you're lucky, even if you're in a case where your income has changed dramatically, you can do a loan modification, and with rates so low that hopefully you can take advantage of that. So like those are super bullish, and we're not going to see these headlines. It's like there are no foreclosures to happen. There are some there are a lot of loan mods, in fact, a couple million loan mods that are going to have to happen. And some of those people will be better off selling. And so right now that's February. It's probably going to be June before we actually, like, it'll probably get extended. But almost like 2/3 of the properties that went into that forbearance program are now out. The remainder, the 2.5 or 2.6 million that are still in the forbearance program, are more likely to be in trouble. So the good ones are out. So we're likely to see fewer of those come out. And so we're probably getting closer to the core number of those that are going to be like, have to do something. But rush to foreclosures, negative equity, short sales, basically not on the board. There are risks. So if interest rates spike a lot, and I pointed out a few places where what that does to demand and to supply. So like, keep your eye on that. There is real renter distress. So when, the headlines typically talk about people losing their homes, they're talking, they talk about mortgages, but they really mean renters. And so there are, pandemic impacted renters, and the world has not figured out what to do about that yet. So that's going to happen. That actually cascades into commercial and multifamily delinquencies. So there's a lot to be worked out there, that is yet to happen, and a lot of fallout there to happen. And it is a risk for the broader market. I am less worried about recession this year than I am in terms of impacting, like derailing our home housing market, than I am of a rate spike. My expectation is you get a moderated rate increase that moderates some market a bit, takes some of the steam out, which is probably healthy. If it happens to spike, then we have new variables to look at, which we will do in a subsequent webinar. I think we hit our topics. Let me just wrap up. It's right at the top of the hour. Get the ebook if you need to talk to your customers. You need to talk to people about the data, get the ebook. Book a one-on-one, look at your local market, and figure out how to build the Altos into your business. And then stay tuned to the YouTube channel, because these videos have been a lot of fun lately. And All right, we're going to call it there. Thank you so much. Happy New Year, everyone. Here is to a prosperous and healthy new year. I love you, people.